There's an old adage out there that goes a little something like this. If you don't hold it, you don't own it.
Bank balances are insured up to $250,000. If you have $251,000 and the bank, goes bust, which has happened recently in the last few years, that extra $1,000 vanishes. You don't get it.
Your gold can't collapse and its value disappear because somebody goes insolvent or somebody goes bankrupt.
Welcome to Bullion Standard, where buyers gain value and members gain insight. And we all go stronger together. Kyle, you're here with me today, and we're going to talk about physical gold versus ETFs versus individual mining stocks.
That's right. So we're talking about 3 different ways you could participate in owning physical precious metals or owning gold virtually via an ETF. ETF, obviously, Charlie stands for Exchange Traded Fund, like the GLD or the SLV. And then we have physical trusts, like the Sprott Physical Gold Trust. We'll talk about the kind of nuances there.
So we've got 4 different distinctions here. We've got ETF and physical trust.
Yep. And then we have, mining stocks. So we have the biggest and the best, like Barrick and Newmont, Agnico Eagle for gold. Hecla Mining is an example for silver. And we'll talk about the differences between them and what the pros and cons of each one are. And hopefully somebody gets a little bit of something out of this video after we finish up.
We'll throw a little disclaimer out there. We are not giving anyone individual advice on stocks or picking stocks or investments. We're just simply going to make some distinctions between these 4 separate structures.
Right.
Okay.
Yeah, so the first thing we'll start off with is the physical gold. So, Charlie, people could buy physical gold bullion, coins, bars, rounds. This is all really typical stuff. And there's a couple of different ways somebody could own it. You could own it self-custody, which is the most popular method out there. This is where an investor would buy physical gold and have it shipped directly to their home.
This is where Bullion Standard customers really gain a lot of momentum when they're inside of the membership program, where they get access to buying bullion with no premiums, retail premiums, no markups.
That's right. It's the direct market maker wholesale price. Of course, Charlie, we've talked about this in a prior episode, and the price difference between the wholesale price and the retail price is quite shocking. But so you could own physical. There's a couple of pros and cons here. The pros are you get to hold it. There's an old adage out there that goes a little something like this. If you don't hold it, you don't own it. And so that comes from the concept that gold is a very unique asset class in that it has no counterparty risk. Mm-hmm. It's an asset that is not simultaneously someone else's liability. So it's not a bond. It doesn't have a coupon. It doesn't pay a yield, but it has no counterparty risk. Your gold can't collapse and its value disappear because somebody goes insolvent or somebody goes bankrupt. So it's an asset that stands on its own, and for that reason, it makes it really interesting and really unique.
Okay, so we've talked about physical a little bit. Anything else that we need to know about physical?
Yeah, the other popular way you could own physical is in your IRA, or you could own it in a storage facility, both of which Bullion Standard can facilitate. If you own it in a storage facility, you would pay an annual premium or a monthly premium. It's usually a very small, like 0.5 or less % of the overall value of the metal.
When you say premium, do you mean a storage fee?
Yes. So it's an annual storage fee. I like to call it a premium because it's kind of like an extra, thing you're paying on top of the gold. But it's stored in a vault. There's tons of them out there, a lot of reputable ones. There's Brinks, there's Loomis, there's IDS, there's the depository in Delaware. There's one in the Cayman Islands as an example, Strategic Wealth Preservation.
Behind the giant steel door with the giant dials on it.
Yep.
Yes.
You could store your gold in Switzerland. You could store your gold in Canada. Tons of different places you could store it. Not as popular as owning it self-custody, though. By far and large, when it comes to physical gold and precious metals ownership, most people like to have it in their hands, in their possession, so they can feel it, they can touch it, they can, go to bed with a very calm sense that everything's going to be okay because that gold will help you sleep at night.
The reality is that, we have these institutions out there, and, when we're not physically present with whatever it is that we own, like, we don't know for sure. We trust, right? We all want to trust, but we don't know for sure that it's there. So it's like you can even check your bank balance, and bank balances are insured up to $250,000 if you have one individual on the bank account from the FDIC, and if you have $251,000 and the bank goes bust, which has happened recently in the last few years, that extra $1,000 vanishes. You don't get it. Okay, so there's a reason right there. And let's say you had $500,000. Let's say you had $10 million. Everything over that 250 disappears. So there is a valid reason why there would be a little anxiety, a little tiny bit of anxiety, that is curative when you can hold the weight of a gold coin or bar in your hand. It is stabilizing.
Let's talk about how fun it is to hold an ounce of gold in your hand. It is so rewarding to hold an ounce of gold in your hand. There's nothing else like it. There's nothing else.
True.
It's
so true. I'm going to expand this. It's empowering. I don't know if for those of us who've fired firearms before, it's a huge responsibility that you have to take very seriously, but it is super empowering. And so in a similar way, when you hold physical bullion and you can feel the weight of that, juxtaposed against a piece of paper, that we all believe has value, there's a clear difference in the experience. And yes, it is foundational and it is stabilizing.
Right. Yeah, absolutely. There's nothing else like it. That's what I like to say. Same thing for an ounce of platinum. Platinum is even more dense than gold, so it has a higher density. And a smaller volume of platinum weighs more than an equivalent volume of gold.
I learn something new every day, and this is something I did not know before. Thank you for saying that.
Yeah.
So happy we get to have these conversations and talk about these things. One of the things that Bullion Standard is a powerful stand for everyone in our membership program, and everyone that's out there interested in generating some wealth, is to learn and grow. And so this is a great opportunity for me as well. I'm on the journey with everyone else.
Yeah, thank you for being here, Charlie, and thank you for co-hosting the show with us. So we talked about physical. We talked about you could own it in your hand, in your home. We talked about the pros. Let's talk about the cons. If you own it physically in your home, you could potentially have somebody over who you weren't inviting. And this person...
An uninvited guest. Dare we call them a guest?
This person may or may not have your best interest in mind, and so there is the risk of theft. Most home insurance policies don't insure against physical bullion. Most home insurance policies will insure against things like jewelry or watches or diamonds. You could typically get that as a personal possession type of thing on your homeowner's insurance policy. But for the most part, if you want to insure bullion in your home, you got to get a different policy with someone else.
Little Lloyd's of London cash insurance. It's
correct.
Like insuring cash.
It's like insuring
Very
cash.
expensive to insure cash.
So that is one of the cons. There are some people who participate in an activity known as midnight gardening. It's where you don't tell anybody when or where you decide to do
some gardening, some AKA gardening.
That's right.
Just rooting out the rhubarb.
Yep. At 1:37 a.m. in the morning in the prime time of day. So yeah, that's one of the cons. And then, one of the cons of owning it in a vault or even in your IRA,
Safe deposit box.
safe deposit box, anywhere that's not in your possession, you don't get the benefit of having it exactly that in your possession. It's in somebody else's possession.
So what you're pointing to is that there are no guarantees in life, even when it comes to owning bullion.
That's right. There are no guarantees. The probabilities are exceedingly high that everything will be cool and nothing will happen, but still, there's nothing quite like owning it in your possession, and when it's in somebody else's possession, you don't get that. So, it's possible that the depository goes bust or something. That's never going to happen because it's insured by Lloyd's of London. All of them are. They all have very strict security ratings. Seismic sensors in the concrete, all kinds of fun stuff that makes physical depositories just a fortress, literally. So I don't think anything has ever happened with a depository, but it is possible, but highly unlikely. So just to wrap that up, it's you don't have it in your possession. That's one of the cons that we see. So yeah, that's kind of an overview of the first way you could own physical precious metals is physically, either in your possession, in a depository, or in your IRA.
How would you hold it in an IRA?
Yeah, so if you want to own gold in your IRA, there's really three components. You have the custodian, you have the bullion dealer, and then you have the depository. Generally, bullion dealers can satisfy two of these three things: the depository and the bullion dealer component. There isn't a bullion dealer out there that is simultaneously the custodian. So you have the custodian. They are bound by IRS rules and regulations on types of product you can own in your IRA, purity requirements, manufacturer requirements. It's not too challenging to navigate, but there are just a couple considerations.
So you need a third-party independent entity that's the custodian, and that's what allows for the qualification for your IRA to be in possession of the tax-deferred status.
The custodian will collaborate with the bullion dealer and have it shipped to a secure depository. That may or may not be a bullion dealer. Some of them do have their own in-house depositories. That again, these places are like fortresses. They're you know what they are, Charlie. We've seen one, and so yeah, it's kind of like a 3 parties involved to facilitate an IRA transaction. And
so you can't own the gold and be in possession of it and have it qualify as tax deferred or gain exempt, tax gain exempt, depending on what kind of IRA you have or retirement account. You're not able to actually hold it in your hand. It has to be held with a custodian.
Has to be in a storage facility under the custodian's control.
Okay,
and
so no rooting out the rhubarb and having it qualify for your IRA.
Correct. So yeah, there's a couple of different IRAs you could have. You could pay taxes when you put the money in, and then whatever you withdraw, that's tax-free in the future. You could pay money in without paying any tax, and then when you make a withdrawal at some point in the future, it's taxable. So there's a couple different options you could do, and it just really depends on your personal strategy and what you're looking to do.
Okay, so we've talked about some physical. We've talked about retirement account. So let's talk about ETFs.
Yeah, let's talk about
and let's also talk about physical trusts as well. Is a physical trust the same as an ETF?
No.
Okay, so let's talk about the distinctions there.
So there's 2 classes of ways you could own precious metals. We'll call it on the stock market. You could own an ETF, exchange traded fund. The 2 big popular ones in the space are the GLD and the SLV.
Let's talk about why someone would own an ETF.
They just want exposure to the spot price of the metal. Mm-hmm. So if the spot price goes up 2%, arguably that ETF should go up 2% as well. So it's exposure to the underlying commodity, which in this case we're talking about gold and silver.
So there's a ease in access to ownership. You hit the button, you own it.
Yep.
In your stock trading account.
Yep.
Okay, so before we move on to physical trusts and talking about the difference between ETFs and physical trusts, is there anything else pro or con that we didn't touch on around ETFs?
So pro would be you don't have to hold it physically in your hands. There's no risk of theft or loss physically. Um,
But there is some legal piping that, there's some complexities. And while we haven't had any, breakdowns in that you know of or that I know of, there's still a risk. No one survives the heat death of the universe when the sun explodes. And so there's always a chance that something catastrophic could happen. Highly unlikely, at least not in our lifetime.
Stackers and investors of physical metals will often chastise the ETFs, such as GLD and SLV, because they're managed by JP Morgan and HSBC, two really big banks in New York City. And they've just been plagued with scandals over the years. And so, for that reason,
we'll do a whole nother video on scandals. And it's really fascinating because, we could get our tinfoil hats on and we could just really dive deep into some of these things, especially around banking. So I enjoy the opportunity to have those conversations while also understanding that while there's truth to it, there's also pros and cons why we have big banks and what the usefulness is of them. And it's really great to learn and understand like the pros and cons and why we would tolerate some things that most of the time people don't tolerate.
So yeah, the pros are that you don't have to worry about theft physically in your possession. Very easy to trade. You could pull up your Schwab account. You could pull up your Robinhood account. You could pull up your Interactive Brokers account. You could hit the buy button on GLD, slap the ask as it's known, or place a bid. And so
slap the ask.
So you could own it very easily and conveniently. The cons, of course, is that the two big ETFs in the space, GLD and SLV, are a little shadowy and weird. And the custodians who manage them have been, plagued with scandal. And for that reason, our audience, our typical consumer of bullion products, the core foundation thing is that they're very untrusting. They're skeptical for good reason too. Gold is a high value asset class, and it's something that you have to build trust into whoever you're dealing with. So let's talk about physical trusts. Complete 360 from ETFs. A physical trust is a vehicle. It's also publicly traded. You can buy it on the stock market. But just like a ETF who holds gold in a vault physically, every ounce is meticulously accounted for. It's actually there. It's audited regularly. The reporting requirements are very strict and very stringent. I know that the biggest one I can think of is the Sprott publicly traded vehicle trusts. Most of the material is kept at the Royal Canadian Mint, and so it's there. It's not going anywhere. And as a trust holder, you are entitled to, take physical redemption if you own enough of it, if you choose. And you can have peace of mind knowing that it's there and it's managed by a great company who has a long track record of success in the industry, Sprott. So, in other words, the risk is very low that anything is ever going to happen to that metal because it's managed by a very good custodian.
What other than Sprott, what other physical trusts are out there for bullion?
Yeah, there's one for platinum and palladium managed by a company called Aberdeen. It's the Aberdeen Physical Platinum and Palladium Trust, financial services management company. So that's another one as an example. I don't know off the top of my head. I can't think right now of others. I believe there are others, but those are the two big ones that stand out in my mind.
What are the fees associated and the difference in the amount of the fees between an ETF and a physical trust?
They're similar. The ETF, I think, is a bit lower. The physical trust is a bit higher.
Okay.
But that fee just gets baked in, automatically, and then, to the net asset value of the fund. And so you don't physically pay that fee just by owning it. It just kind of comes out on its own.
And the reason I ask is there's a loss in correlation to the spot price. So when there's a increase or decrease in the spot price, when there's an increase in the spot price, you're not going to get a 100% accurate correlation with that amount because there's some fees involved.
Right.
Okay, anything else to distinguish around ETFs or physical trusts?
Well, we didn't talk about the cons of a physical trust.
Okay.
And my opinion is that it's similar to the con of an ETF. You don't own it in your possession physically. We can't have it right here in front of us in our hands. Not too many cons with the physical trust, just you can't hold it in your possession, and typically it's much more transparent than an ETF, which, as we discussed, especially managed by these big banks, are kind of shadowy, and we don't really like them too much. So, all right, let's talk about mining stocks, the very end of the quality trail. So at the very top, you have the physical gold. You go down a notch, you have physical ETFs and physical trusts. And then at the very bottom, you have gold stocks and gold mining companies.
Let's make, inside of mining companies, let's make the distinction between the different kinds of mining companies. So you've got your bigger producers, companies that own, operate, manage massive mines, just millions and millions of dollars worth of equipment and infrastructure, and they're out there in the grind every day, digging in the dirt, spraying the solution on the leach fields. I don't know all the things, but we've gone to some mines, and it's pretty fascinating. Again, like, it would be really amazing to create a field trip for our members and actually go to a mine. I want to do that one day, so let's do that. But so we've got the big miners, then we've got the medium tiers, and we'll talk about that and who they are and what they are, and then you've got the what do you call them? The moose pasture companies, where they have a claim to some land. There's a suspicion there might be some precious metals in the ground. And here's something to know. And I didn't know this, precious metals are not always physically visible. Most mines, I'm guessing most mines, some mines at least, you will never see the metal. Like, you'll never see a nugget. It's actually something that you have to, like, pulverize the ore, turn it into something that gets mixed into a solution that dissolves the gold or silver, and then that solution goes to a processor, and they pull the molecular level gold and silver out of the solution. Absolutely fascinating. And some of these mines, they have these giant ball crushers. I can't remember what they're called, but they're like a 3-story washing machine turned sideways. And they've got these giant cannonballs that go in there, and it just spins, and the cannonballs pulverize the ore, and then that powderish ore is now mixed into a solution, and then that solution is then filtered out, and it goes to the, what we call it, the refiner. Absolutely fascinating. Everyone needs to see this equipment for themselves.
I think the thing that we could take away from it is that there's a guy who would say mining is so critical to everything we do in life, because everything we see and touch was either mined or grown. Everything.
Great point. This is also something that blew my mind when we started talking about it. What do we have? We have stuff. Where did the stuff come from? We have houses. Started out with blocks and wood. And so people are mining blocks out of a quarry. People are mining trees. Everything else is a product of some sort of oil, petroleum, or it's some sort of precious metal. It all came from the ground. Everything we own, this pen, this notebook, this glass bottle, everything was mined.
That's right.
In some fashion. So let's just think about that for a second.
One last thing to say on that is that we would say it's just a miracle that anything exists, because one wouldn't understand the complexity of mining until you visit the mouth of a massive open pit mine in the Nevada desert.
Yes, it is a miracle. We walk around as if cell phones and air conditioning are a right and we deserve them. And okay, so most mines fail. From the cow pasture, high failure rate, where they're going to spend, hundreds of thousands, millions of dollars drilling into the ground, trying to strike the vein that will show them this is worth developing. And it's just such a complex process where you have to hit all the marks just right to actually end up with a pit that is produced and everyone gets fed off of that, including the consumer. With air conditioning and solar panels and phones and all the stuff. And so it is a miracle, and it's absolutely the case that it requires the smartest, the brightest, the most determined people in the process go into it every day, making it happen. And if that structure is interrupted, it's a failure. So it's absolutely insane to sit and think about what we've built on the planet and what it's taken to get that, and how fragile it is. The slightest little interruption in a mine and it's done.
So let's talk about the levels of mining. So we talked about the physical, we talked about the ETFs and physical trusts. Let's talk about the mining. So as you suggest, just like there's these layers of how you could own it, there precious metals, there's layers of different classification of mining stock. Senior gold producers, the biggest of the best, big companies who own a lot of different assets, likely all around the world. And then we have the mid-tier developers. These are people who likely already have an asset and they're developing it. They're making progress. And then we have at the very bottom, the very highly speculative, as you suggest, pasture plays. So
moose pasture.
If you're in Canada, this would be moose pasture. If you're down under in the land of Oz, it could be kangaroo pasture. If you're in
South America, might be something like anaconda pasture.
Yeah, if you're in Africa, it could be elephant pasture. So just depends where you're at in the world, but that's just a fun play on it, of course. But the point is that these junior explorer companies, they don't have any metal in the ground that they've discovered, and they don't have any that they own. They're exploring for it. So it's very highly speculative. So let's talk about, it's called the quality trail. The big senior producers are leveraged to the gold price. So when you have something that you're mining and the price of it goes up, your margin will go up. And so the share price of these companies typically escalates at a higher percentage rate than the underlying commodity does.
Let's unpack that a little bit. So I think what you're saying is you've got a big mining company. They've gone through the process. They're existing. They have production, and they have their costs. And, costs fluctuate a little bit. Inflation happens. Fuel prices go up and down. Labor costs typically go up. So over a period of time, you could say this is, plus or minus a pretty stable fixed cost of operating. And in the bigger swings of market cycles with precious metals, you'll have longer bull runs and bear runs. And so when you're, let's say, at the bottom of a market cycle and the mine is operating, and sometimes the mines will increase and decrease production based on the underlying price, spot price of the metal. But when the price goes up, there's a increased net profit that is outsized compared to the physical precious metal. So if it costs you, let's just say gold, for instance, it costs you $1,000 an ounce to produce out of the mine, and the price is $800. Well, you're losing $200 an ounce. Well, what happens when the price is $1,200? Well, you're making $200. Well, what happens when the price goes from $1,200 and you're making $200 and it goes to $1,400? You've doubled your profit.
That's right.
So now let's say it costs you $1,000 an ounce to mine it, and you go to $2,000. Well, now you've 5x'd your profit from $1,200.
That's right.
So you can do the math at home and understand the significance of the risk-reward proposition with mining companies. Okay, so continue.
It's also to note, too, that the big senior producers, their operating costs can also go up, which can affect their profit margins. But typically in a gold bull market where the price of gold is just continually on an uptrend, the price goes up quicker than their expense and cost of production goes up. And so this is where you get crazy, crazy moves in gold and precious metal stocks.
Mining stocks.
Yeah, mining stocks. So, yeah, and then you have the mid-tier producers and developers who may only have like a single asset or they're developing a mine. And so those people typically enjoy more favor in the market as the bull market in precious metals continues.
It's really interesting. I would like to unpack this a little bit more and kind of flush out why this is. I think I know, but I'm interested in what you think about it as well. Big mining companies, mid-tiers, they've all now moved. And now here come the laggards, the people that have the possibility of discovering something. So they have some sort of right to, exploring and discovering. And at the very blow-off top of a bull market, we'll call it, some of these companies will have not moved yet. And then maybe because the retail consumer of mining stocks or purchaser of mining stocks now comes in and they might see an opportunity to buy something at a very low price. The psychology of it is, hey, all these moves have happened, so therefore, let's find something that hasn't moved, which is probably the most, emotional and illogical thing you could do. But when we have, people who were like me years ago and said, well, let's just participate and find out. How do you learn? You start. And so people come in and they're like flooding money into a sector that usually gets zero retail action, zero interest retail. And then you've got these exploration companies that might have some sort of news that comes out and now they're in the spotlight and now they're just getting a lot of activity. Price skyrockets.
That's right. So yeah, it's around retail and market psychology. As precious metals bull market progresses, interest transfers down, and at the very end of the bull market is when all the little super speculative explorer companies who don't have anything in hand just go bananas.
Well, let's connect the dots here a little bit. Our intention is to give people a little sampling of, all these different opportunities. But also we want to be mindful and let people know that if you're going to participate in a stock or an investment, participating in the market, get a lot of support, educate yourself very well first. You don't want to be the person who's coming in at the end and spending money on something because you're making an emotional decision. Educate yourself, create a thesis, understand it, discuss it with people, go to conferences, do a lot of reading, watch people who are, successful. Don't be the smartest person in the room. Find the room where there are very intelligent people and learn from them. And then, participate at the level that you're willing to lose. So if you're going to invest in a volatile sector like explorers, I would say be willing to lose every penny you put in.
That's right.
And, have a plan, but create an opportunity to learn from your actions. That's what I would say.
Ladies and gentlemen, thank you for joining us on another episode of the Bullion Standard Podcast. Charlie, thank you so much, and signing out for now.
Okay, and as we sign out, let's also say, remember, every ounce matters, and so does every insight. Until next time, stay informed, stay committed to growth, and hold your standard high.